Hey everyone, welcome to part 2 of the Riskier Mutual Funds chapter, chapter 12. In this one, we're going to be looking at balanced funds. Okay, so a balanced mutual fund means that they invest not only in equities, but also in fixed income such as bonds. Okay, so it's often referred to a hybrid product. Now, even though it says it's a balanced mutual fund, that doesn't mean that it's a 50-50 split, okay? But ideally, it does provide a certain balance between a mix of safety, income, and capital appreciation. Okay, so a portfolio manager attempts to shift proportions of the investments in the fixed income and the equity in keeping with the changes that are going on in the market at that specific moment. Okay, so if interest rates are at a peak, managers will want to have got in to more fixed income securities before they peaked. And then if stock markets are set to increase, then managers want to have the majority of that, the money from the fund into stocks before the stocks increase, right? So it's trying to gain earnings in both areas, getting in just before the fixed incomes increase and getting in just before the stocks increase. So stock and bond markets are volatile, and managers hold large amounts of money in market securities, okay, to help counterbalance this. So they do make sure that not all of the capital is invested in either fixed income or equity. They do keep some in money market securities. So basically, managers try to time the markets that it's best that they can get the best deal that they can in both. Balanced funds do not need to hold a balance, as I was mentioning, and they will never hold, even if the stock market is going up and they want to get in before that rises, they're still not going to take all of the capital in the in the mutual fund and invest it in that area. They're still going to balance it out. Okay, so these objectives are sought through a portfolio of mixed income securities for stability and income, plus a broadly diversified group of common stock holdings for diversification, dividend income, and growth potential. Managers of balanced funds adjust the percentage, as I was saying, of each part of the total portfolio depending on the current market conditions. And since balanced funds are part bond and part equity, you may expect them to perform midway between the performance, but as I mentioned, it tries to take advantage of the highs in the fixed income and the highs in the equity. So therefore, overall, it would have a higher 15-year average than the other two. Although at this point, the 15-year average amount or percentage was not available. Okay, so next we're going to move on to target date funds. Okay, so it's a new type of balanced fund that it actually works on life cycles. Okay, so and it was introduced back in 2005. It has a maturity date and a glide path. Okay, so say it's going to mature in 20 years. So maybe you want to invest in a target date fund so that it matures just as you're about to retire. And say your retirement's 20 years away, the closer you get to that maturity date, the less risky assets are invested in, okay? So that it's not as risky when you go to cash in the fund. Okay, so this fund is structured on the assumption that risk tolerance declines as the investor gets older. And upon maturity, these funds are moved, as I said, out of the target date group and into an appropriate fixed income or balanced fund category. Next, we have global mutual funds. Okay, so global mutual funds hold assets from many countries in their portfolios. So global funds hold securities from many countries, including Canada. But if it's called an international fund, it means that it invests in many different countries, but not in Canada. So some mutual funds specialize in a particular country or region, such as Asian funds, European funds, Japanese funds, or US funds. So global funds can be bond funds, equity funds, or virtually any type of fund. But the most common type of global fund is the global equity fund. So you're investing in the equity or the stocks of international organizations, including Canadian ones. Okay, so investment objectives of global mutual funds depend on the first class of security they are designed to hold in their portfolio. Okay, so if it's an equity fund, then they're going to focus on an equity fund. If it's an international bond fund, on the other hand, it will earn interest income with some capital gains, not many, but over a somewhat shorter horizon. And where it is an international bond fund, it will not hold any Canadian bonds. So investors are attracted to global mutual funds for two main reasons. And this is that at any point in time, different countries are at different stages in an economic cycle. So because it's diversified across many different countries, then it can take advantage of those different stages and focus on the countries at certain times that are in better economic conditions. And also, they provide a hedge against the decline in the relative value of the Canadian dollar. Okay, so the global mutual fund is subjects its clients to at least two different types of risk. One is the market risk of the country in which the fund is invested, and the second is the foreign exchange risk. Okay, because the value of the Canadian dollar can rise or fall in relation to the currency of another country. So all of a sudden, if the value of our dollar falls, then our dollar's not going to be worth as much investing in a different country. Okay, so not all global mutual funds expose clients to foreign exchange risk. Portfolio managers can undertake hedging transactions in the foreign exchange market to remove or greatly reduce this risk. And they can do this by selling foreign exchange currency for future settlement, so that through this currency exchange contract, they can reduce the risk associated. Global mutual funds prospectus will indicate whether or not the fund hedges the foreign currency risk. And it is important for mutual fund sales representatives to know whether the global mutual fund hedges for the foreign exchange risk, because some clients would rather bear this risk themselves, whereas others would rather have it taken care of through the hedging. Okay, so in addition to market and foreign exchange risk, there are other risk factors in the global mutual funds. One is the accounting practices are different or could be different in different countries, even though now, as of the last 5 or 10 years, I can't remember exactly when, A new accounting practice came into place called International Financial Reporting Standards, and many countries around the world have adopted this practice so that the accounting practices within the different countries are more similar, and the main reason being just this, so that anyone looking to invest in the company of a certain country, they know that because they follow IFRS, that they can rely on the accounting records, that they are what they would be as if it was a Canadian organization. Also, the liquidity and efficiency of the foreign stock exchange is another risk for global mutual funds. Okay, so please note that dividends from global funds do not come from Canadian corporations. They come from international corporations, and therefore they are not eligible for the dividend tax credit. Okay, so if you remember, because of the dividend tax credit that's provided in Canada when you do your tax return, and you only pay your dividend as if you only earned 2/3 of it instead of the whole amount, therefore the dividends from the foreign source are going to be taxed more similar like interest income. The whole amount is going to be taxed. Okay, so the investment objectives of global equity funds are to earn dividend income from a diversified portfolio of quality global shares, but again, primarily their focus is on earning capital gains, so that when you purchase the shares and then when you sell the shares, that is where the investor is going to make their money, on the amount that they earn between the purchase price and the sell price. Okay, so the return, so the average 15-year return on global equity funds is listed in your textbook as 2.84%, compared to the Canadian equity funds of 6.17. However, I know this average rate of 12.84 is an old statistic, so therefore it's not accurate. However, it is what is in your textbook. Okay, so we do have a little bit more to cover. However, where my video only goes to 15 minutes, I am going to stop here. We will see you for part 3. Thanks, everyone.